Are you struggling to find momentum in the stock market? Are you unsure what to buy, when to buy, and even when to sell? Or are you just scared to get started, worrying you're going to lose all your money? I was, until I discovered these 4 golden tips that totally transformed my investing mindset and helped me achieve over a 48% return in my first 12 months. So in this video, I'm going to show you how to make an insane return in the market using some incredible tips from the world's best investor, Warren Buffett. We'll look through his most recent shareholder letter and see exactly how the man himself is investing this year. And at the end of the video, I'm going to reveal the most important reason Buffett's achieved incredible stock market success. And honestly, it will shock you how simple it really is and how easily you can take advantage of it. Jumping straight into the 2024 shareholder letter, the first material items to look at are the tribute to Charlie Munger, Buffett's longtime friend and business partner who sadly passed away in November 2023, and Buffett's view on changes in IFRS standards. The entire first page of the letter is dedicated to Charlie Munger, and the main points detailed are Charlie's early advice to Warren, essentially telling him to focus on the quality of the business rather than finding cheap stuff. Other than that, Buffett went on to give immense credit to Charlie for his involvement in Berkshire's success, quoting the following: "In reality, Charlie was the architect of the present Berkshire, and I acted as general contractor to carry out the day-by-day construction of his vision. Charlie never sought to take credit for the role as creator, but let me take the bows and receive the accolades." It's really impressive for Buffett to say that, and nice to see Charlie get some credit he perhaps didn't get before. The next thing we're going to look at is Buffett's simple formula for incredible success in the stock market. But first, the next noteworthy item on the letter is simply Buffett complaining about changes to accounting standards. In short, recent changes to accounting standards require unrealized capital gains to be included in net income, which of course for a company like Berkshire means that the fluctuating stock market can significantly affect their financials, making it more difficult to assess the true performance of the business. With a traditional company that just sells goods or services and doesn't hold a significant stock portfolio, this issue doesn't really arise. But of course for a business like Berkshire that has a sizable $350 billion stock portfolio, this has a huge impact. The unrealized capital gains has the potential to significantly swing the bottom line. In Buffett's words, this effect can be up to $5 billion a day. That's insane. Buffett's advice for this is really simple. When reviewing the performance of a business, ignore these numbers and focus on how much money the business operations are actually making. Now we move on to the really juicy stuff. Firstly, with Buffett running through his investment strategy and exactly how he picks outstanding stocks. He quoted, "He'll always look for businesses that enjoy good economics that are fundamental and enduring." What does this mean? Well, essentially this means he looks for businesses that have a competitive advantage. To give an example, Coke is always going to be Coke. It's one of the most recognized brands worldwide, with a strong and positive brand image that spans over a century. This extensive brand loyalty ensures a stable and consistent customer base. He goes on to say, "We also hope these favored businesses are run by able and trustworthy managers." And if you're familiar with Buffett's approach, you'll know this is 2 parts of his entire approach. The others being understand the business and ensure a margin of safety. This means the price is low enough to reduce risk of the investment, but Buffett has openly said previously that if you find a business that ticks the previous 3 boxes and isn't overpriced, that also works too. So essentially he's just doubling down on his standard approach and highlighting the importance of it. This next tip from the investing genius is one of the most overlooked aspects of investing, but is so incredibly important. Buffett says, "Occasionally markets and or the economy will cause stocks and bonds of some large and fundamentally good businesses to be strikingly mispriced." He goes on to say, "If you believe that American investors are now more stable than in the past, think back to September 2008. Such instant panics won't happen often, but they will happen. When investors panic, and nowadays there is significantly more retail investors than ever before, they'll rush to sell off their assets to avoid potential losses, overwhelming the market and driving the stock prices down rapidly. This panic spreads quickly across global markets, and with the incredible speed of which information can travel at nowadays, market crashes will inevitably happen in the future. But the key and the tip here is to stay calm. If you're prepared for this eventuality, you can actually use it to your advantage. For example, if you're keeping a close eye on a few high quality businesses that tick the first 3 concepts we looked at earlier, all you have to do is wait until the markets do eventually suffer and then seize the opportunity for the long term. Essentially, wait for the panic to commence, buy the great stuff in the short term drop and hold it for the long term recovery. But you have to stay cool, calm and collected. Otherwise you'll fold, sell low and make a loss. Next, we'll look at the secret reason Buffett's achieved incredible stock market success over the years, and it will shock you how simple it really is. But first, his number 1 rule of investing. One investment rule at Berkshire has not and will not change. Never risk permanent loss of capital. Thanks to the American tailwind and the power of compound interest, the arena in which we operate has been and will be rewarding if you make a couple of good decisions during a lifetime and avoid serious mistakes. I think what Buffett is saying here is stick to the long-term approach that he's always adopted, rather than looking for overnight success. It can be so easy to get sucked into the short-term gambles, as he states here. Though the stock market is massively larger than it was in our early years, today's active participants are neither more emotionally stable nor better taught than when I was in school. For whatever reasons, markets now exhibit far more casino-like behavior than they ever did when I was young. The casino now resides in many homes and daily tempts the occupants. The long-term approach, however, ensures that investors avoid significant, irreversible losses and benefit from the power of compound interest over time. Buffett believes that by making a few wise decisions and steering clear of catastrophic mistakes, investors can achieve substantial long-term rewards, especially given the historic resilience and growth of the American economy. During the 2008 financial crisis, many investors suffered massive losses due to risky, leveraged investments. In contrast, Buffett's Berkshire Hathaway focused on fundamentally strong companies and avoided such catastrophic losses, and was well positioned to recover and grow afterwards. This point leads me on nicely to the secret reason Buffett's achieved incredible stock market success. He quotes, "When you find a truly wonderful business, stick with it. Patience pays, and one wonderful business can offset many mediocre decisions that are inevitable." He backs this up by discussing in depth Berkshire's investment in Coke and American Express and their journey over the years. Last year, I mentioned 2 of Berkshire's long duration partial ownership positions, Coca-Cola and American Express. These are not huge commitments like our Apple position. Each only accounts for 4 to 5% of Berkshire's GAAP net worth, but they are meaningful assets and also illustrate our thought processes. He goes on to discuss the company's journeys from when they began operations to the present day, detailing that as each base business was so successful, they developed into some of Berkshire's strongest investments. During 2023, we did not buy or sell a share of either Amex or Coke, extending our own Rip Van Winkle slumber that has now lasted well over 2 decades. Both companies again rewarded our inaction last year by increasing their earnings and dividends. Indeed, our share of Amex earnings in 2023 considerably exceeded the 1.3 billion cost of our long ago purchase. In addition to this, he states, both Amex and Coke will almost certainly increase their dividends in 2024, about 16% in the case of Amex, and we will most certainly leave our holdings untouched throughout the year. Could I create a better worldwide business that these 2 enjoy? As Bertie will tell you, no way. Buffett previously said that the success of Berkshire ultimately comes down to around a dozen truly good investments. That's it. So in summary, stick to a few good businesses and investments for the long term, and they'll offset and outshine the mediocre ones.